Hello everyone, welcome to Insurance Business TV and an exclusive roundtable edition on construction insurance in association with Amwins, entitled Building Certainty in Uncertain Times, How E&S Expertise is Shaping the Future of the Construction Casualty Market. Now, in today's volatile construction landscape, rising material costs, labour shortages and legal pressures are driving increased demand for casualty insurance and pushing more business into the E&S space. Well, today, Amwins experts will unpack the market forces at play, explore how these trends are reshaping supply and demand, and share how strategic underwriting, data-driven insights, and deep carrier relationships are positioning wholesalers to deliver meaningful value to brokers and retailers who are navigating that uncertainty. And for that journey, they have put together a panel of experts. They are Jet Abramson. He is Executive Vice President and National Construction Practice Leader Casualty at Amwins Brokerage. Helen Fry, Head of Casualty Programs at Amwins Special Risk Underwriters. And Nick Delvino, Executive Vice President Casualty at Amwins Brokerage. And Nick, it's you who I'm going to start with first, if I can. Just outline for us some of the challenges and trends that are impacting the construction market today.
Hi, Paul. Thanks for the question. The overarching theme of what we're looking at when we talk about construction, the construction industry, is what's the economy doing? The construction industry is very tied in with the economy. It's really the largest piece of the economy. So on a large scale, what we've been seeing right now in the economy is the key word is uncertainty. Well, you have certain sectors of the economy that are trending in a more positive level. Right now in the industrial space, data centers are booming. In residential, you have office conversions to residential with a lot of demand in the residential space. This is an opportunity that and certain developers have been able to capitalize. But overall, with persistent elevated interest rates, it's been difficult for a lot of construction companies to truly capitalize on the need to build more. And this also carries into the civic and infrastructure area, where there's still a lot of demand, there's still a lot of need. The capital's there from the federal funding, but there's delays related to inconsistent, bureaucratic dealing with funding on a small local levels, as well as material shortages. So the material shortages we should talk about a little bit. There's some lingering knockoff effects from the COVID years where a lot of companies were forced to stockpile certain materials to deal with the delays in the supply chain. We've seen that level off, but now with the current U.S. administration, imposing tariffs and then taking back the tariffs and then reimposing, it's been very difficult. But it's a significant challenge when they cannot accurately predict the cost of materials. And so they're either being forced to stockpile materials. We've seen some of them do that successfully, but on the whole, that delay in materials being able to be delivered, as well as the inflated cost, has been a continued challenge.
I think there were two main points that stood out for me there when Nick was talking. One was about growth levels, which I assume, Jet, have to be influenced somewhat by private equity. And another, of course, was that ongoing point around uncertainty. And I guess that brings to mind the labor shortages that the market is facing.
Yeah, these are more trends than challenges, but I think the portfolio managers at private equity companies ran out of accountants and insurance brokers to buy. So now they're buying HVAC contractors and roofers and plumbers. And it's wild. Some of them, the better ones, I think, are learning from the business owners that they bought out and keeping them around, building relationships with, if it's a general contractor, the subcontractors, or if it's a subcontractor, the suppliers and the labor. And then maybe the worst of the worst are extremely profit seeking. They do not want to keep people on. They are not looking to learn. They are strictly looking to flip this thing in 5 years for a profit after they roll them up. But that trend, it has, ripple effects in the market, right? So if you are a local HVAC contractor and then a private equity company comes into town and buys your 5 largest competitors, it is going to become more difficult for you to compete with them. And then you brought up labor shortages. We're seeing that everywhere. It's not necessarily a shortage of labor, but it's a shortage of skilled labor. we are going to need more plumbers. It's going to take a longer time for ChatGPT to replumb my house than it's going to take for it to write a resume, right? So I think that trend, it will get better, but we're in a state of flux right now where there just isn't enough labor. And that is another constraint on the residential housing demand, and the ability of the industry to meet that demand is that they don't have the skilled labor to actually go out and produce all these homes, among other challenges.
Yeah, you don't know how much I'm waiting for ChatGPT to replumb my house. But when we're talking about construction and all these trends and all of the challenges that we're facing, particularly the uncertainty, Helen, we've got to dive in a little bit about litigation, haven't we? That's such an overwhelming arc for the industry right now.
Absolutely, Paul. I think it's one of the things that's plaguing insurance carriers more than anything else right now. And of course, that flows down to the people purchasing the insurance. Litigation funding has become a really big private equity focus. To Jet's point, private equity is looking at ways to maximize return, and they're turning to litigation funding. And what they're doing is providing a really robust budget for lawyers to hire experts that previously would have been out of reach and out of touch for the average litigant. It's enabling them to litigate a case for a lot longer. And right now, a quick settlement for a lawyer is not a good settlement. More now than ever, the cost of claims is increasing year over year. So if they wait 2 or 3 years, $1 million claim is going to be $1.5 million, $2 million. So there's really an incentive there to drag the litigation on. And to do that, they have to really build the case with experts. And that's where they're turning to litigation funding. It's a really good return for private equity firms, and they're doubling down on it more than we've ever seen before.
And if I can just delve in a little bit more in terms of the trends that are impacting the supply and demand of construction casualty insurance in the E&S marketplace right now. Any thoughts around that, Jet? I mean, where are retailers coming to us for their needs versus, say, 5-10 years ago?
Yeah, if you rewind a decade, we were an integral part of the market. E&S was roughly 10% of all, call it package, non-specialty type business. We are the specialty market, but let's say commercial lines, we were roughly 10% of the premium, and today we're 20. So that is tremendous growth over a decade for our industry. And if you look at what people were using us for in the past, we were kind of a necessary evil. You have an account, it does residential construction in a CD state, or it has horrible loss history, or there's something very unique about it. There were certain things where you had to use a wholesaler, and the retailers begrudgingly would do so. But they also went through as many hoops as they could to try to not use wholesalers, right? Today, there are still some legacy folks, I think, that have been in the market a while that still think they get a gold star when they don't use a wholesaler. But to me, the more strategic retailers that understand the market trends, they're looking right now at how they can better partner with their wholesaler. The marketplace on the standard side has cut capacity so much and raised pricing to the point where at certain attachment points, our marketplace becomes competitive, right? We also lift some of the work off of the retailer's desk if they want to go to all of their markets and we're going to ours. So today we're utilized more for our expertise and our market relationships and how we structure deals than in the past, where we were only used when they ran out of capacity, or if it was just a class of business that basically couldn't be done in the admitted market.
Yeah, I love that. A perfect description. And Nick, from your perspective, have you seen things change over the last 5 to 10 years?
Jet really touched on most of it. The key is the boom in E&S, not just being a necessary evil. And that boom is driven by a number of things, largely just loss trends across the industry, which we had a hardening of the market, a pretty severe hardening of our casualty market in 21, 22. And that brought a large amount as rates skyrocketed, and it was very painful for the insureds. That brought a massive boom in capacity, as a lot of private equity money in general was chasing this business, these elevated rates. So now we are in a position where we have a bevy of carriers that are competing and jostling to get on business. And at the same time, the standard market has been massively just reacting to these trends and losses. So they have been cutting capacity pretty significantly. So what that does is it's not only driven business to E&S just because we have capacity and we're able to help fill out towers, but we're we have more competitiveness in our space. So we're be able to get creative. There's all of these carriers that are both established and new, realize that in order to be successful, they have to focus on solution-oriented underwriting. So there's creativity is kind of the name of the game. And just last thing, touching on again Jet's last point. Specialization has become vital. You have companies that only work on construction business because they realize that will give them a leg up. Same thing that Amwins has been preaching for as long as I've been here. As you specialize and you focus on a specific niche of business, specifically, what we're talking about today is construction, you are going to know the ins and outs of every placement. Our underwriters are in the same boat as us. They've really gone all in on that philosophy, and it's been a massive boon to us to be able to, again, deal with these new emerging risks in the construction space, and really just difficulty in placing complex business that is prone to losses. So we're just ready to be nimble, and our carriers are along here with us.
Yeah, and again, 2 points stood out for me there from Nick speaking, Helen, and one of them was around those increasing losses and also the impact on the towers as well.
Yeah, as I mentioned earlier, litigation funding is definitely driving up loss costs, but that's only a small portion of it. Juries today are much more sympathetic to a plaintiff in a very well-prepared case. The plaintiff bar is more organised than they ever have been. They have seminars to teach reptilian theories and how to resonate with jurors to get the biggest verdicts possible. We're seeing jury return verdicts that we had never even contemplated before. Things that used to be in the hundreds of thousands are now routinely in the millions. We're seeing billion-dollar verdicts on things that you would never have imagined. And the other thing that's going into claim costs is the inflation, material cost increase. If you've got a property damage component to a claim, you're definitely paying more for it now than you did before, and that will continue to increase. So staying ahead of those loss cost trends is really difficult because they're so rapid in their movement. It's hard for carriers to stay on top. So that's definitely an ongoing concern. But to Jet's point earlier, that's what's pushing the standard market out of some of these insurance towers because of that uncertainty, increasing loss costs. They're also constrained by rate and filing of forms that the E&S space isn't. So we're able to quickly adjust and move down the tower in response to the standard lines cutback of capacity and create a really meaningful solution for our construction insureds.
Yeah, and that's the big point, isn't it, Jet? I mean, the reason why E&S stands out is its ability to adjust.
Yeah, exactly. I mean, and that's why you see a lot of capacity being pushed towards the E&S marketplace, including looking recently at personal lines in the coastal cities of California, right? It's the difficulty for them to seek rate increases with approval from the state. They're just deciding to move that business into the E&S channel where we have that freedom of rate and form, and we can tailor something specific to a client. That was always the E&S industry's kind of foundation, where these risks that were so unique and unusual that they needed tailored coverage for it to be a risk that can be transferred at a viable price. And it's not that necessarily today these accounts have to be that difficult. It's just that it's a regulatory issue. It's that the amount of money that the regulators will let you get for risk doesn't match the risk that we're seeing in the world today. So it's a lot easier in E&S where you can do basically not whatever you want, but pretty close.
If I could add to that, Paul, it's Jet touched on the rising cost of insurance. We kind of skirted around that. I think, well, we mentioned it a few times. That has created a lot of pain for a lot of the clients. So that's caused a need to just constantly engage with the marketplace. And so what we're seeing as a result of that is not only in our space, but all carriers across the board are just being inundated with submissions and opportunities. And it can be very difficult to manage that. And I bring that up because we're talking about the boom of E&S. Carriers, and you could hear it from them, but this is what they tell us as well. They are only able to execute on this business by being efficient in their distribution. So their distribution model of focusing on wholesale, on E&S brokers that specialize in certain types of business, that can funnel accounts, that can do a lot of their pre-vetting work for them, enables them to grow at a much faster level than if they're trying to work with everyone. It's just not gonna be efficient. And so that efficiency model of carefully picking out your distribution has really kind of, I think, been a huge element of the boom in E&S.
Yeah, I would dovetail onto what Nick is saying. The challenge that a lot of carriers have is insurance is not the sexiest occupation for folks graduating college. So we've got this real dichotomy right now. We've got a lot of experienced folks that are retiring from the industry, and there's not a lot of underwriters to backfill. So the importance of submission completeness and providing all of the information necessary to fully underwrite and price a risk is more key now than it ever has been. I will say that underwriters have to make a choice every day on which submissions they're going to get time to look at. So the completeness of that information is definitely something that we focus on.
Well, that's obviously the solution to the problem, but let's just delve a little bit more into those issues if we can. Let's talk about some of the red flags that we're seeing in today's construction submissions, and indeed how those economic and operational pressures are adding to those concerns. Helen, any thoughts?
Yeah, definitely. I mean, a lot of the large projects get built today through financing. We're seeing lender requirements on terms and conditions on the insurance policy that are much more detailed and granular than we've ever seen before. Lenders are trying to become insurance experts and requiring certain terms and conditions to be in place that don't always make sense. And there's a little bit of challenge there for insureds because insurance carriers don't want to provide those provisions. They're either overly broad, they're unnecessary, but lenders won't close the loan unless those provisions exist. So one of the benefits of an E&S market is we're able to be a lot more flexible with terms and conditions to meet those lender requirements. Some of the requirements standard markets can't meet because they don't have the right forms filed or they just don't have the stomach for it. So we're having to be super creative to meet those lender requirements so that the insured can secure their funding and put a shovel in the ground, so to speak.
And what about in the revenues that are being reported, Helen? Any red flags there?
Such a challenge for insureds and retailers and brokers right now to really report revenues accurately. But you've got the hold up in materials, you've got the potential increases because of tariffs, the economy at large, inflation. So it's really difficult to know when projects will start, in what policy year, but also what the cost will be. So one thing we're doing from an underwriting perspective is we're looking at historical revenues more closely than we may have in the past. And if the current reported revenue doesn't make a ton of sense based on where they've been in the past, you'll get a lot of questions back from your underwriting team on why the disconnect between years prior and the future projections. And for an underwriter, the challenge I have is if revenues are underreported, particularly in an excess tower where we don't typically audit a policy, I'm fearful that I'm providing coverage for much more than I'm charging for. So we're starting to do things creatively from an underwriting standpoint, like making excess policies auditable where they may not have been before. So we're doing premium audits on excess policies, which is a big challenge for insureds because they've now got a budget for a potential additional premium for their excess insurance that they wouldn't have had to contemplate in the past. So things like that are really a strong focus for underwriters today.
Yeah, obviously, and underwriters responding really well. But let's talk about some of the practical strategies and solutions that the brokers and retailers can use to navigate and overcome some of these challenges as well. Jet, any thoughts on this?
Yeah, there's one thing I think we do here at Amwins that either others don't do at all or they struggle to replicate is we have built a culture here where everyone is at least civil, if not actually very good friends, right? So we collaborate across different geographies and product lines and even niche spaces within the industry because, no matter how large of a broker you are, you're not going to see everything every day, right? And it's hard to keep your finger on the pulse of so many different niche market spaces within our world. So when we have that kind of collaboration across geographies and colleagues and offices and whatnot, it makes the placement that much better.
Culture, obviously, very important indeed, but I imagine, Nick, as well, that expertise is crucial.
We have to know what we're doing, and really on a very granular level. So even within our company, and even we see this on the underwriting side as well, it's so important to work with people who are engaged on a very granular level on that specific type of business, because of the variability that we see in the market. Whether I sit in New York, so the New York construction space, very unique with the New York labor law statutes in place that completely that require entirely different solutions for insurance that are not needed in any other place in the country. So you want to, when you're picking your wholesaler, when you're picking your broker team, don't be afraid to ask them questions, quiz them, make sure that they really know the ins and outs of that particular sub niche of the market. Jet would I tell you on end what's going on in California with construction defect for residential construction. Again, like whatever the risk that you're placing is, make sure that who you're working with is a true expert, because they are out there. That's something that we pride ourselves on, and it makes a world of difference in terms of getting the best solution.
Okay, so collaboration, specialism as well. And Helen, I imagine you've got to be constantly evolving your products.
Absolutely. One of the things that we pride ourselves on at Amwins is finding solutions for our wholesale brokers so that they can go to market with capacity, good pricing, great terms. So in our special risk underwriting area, we actually have a very robust product development team, and we respond to market pressures. So an example, recently, there's been a lot of cutback in capacity in the excess casualty space. So we've developed a program where we can provide capacity alongside the carriers that our brokers are already working with on a quota share basis to help build towers and make sure there's enough insurance in place to get to whatever target level of tower there is, whether it's a $50 million tower, 100 or more. We look to plug gaps that are created as other carriers shrink their capacity down in response to the loss costs that we're seeing.
Of course, whenever we're talking about developing products or developing relationships, we're constantly looking at data as well, aren't we, Nick?
Yeah. Amwins has always prided ourselves on collecting data and providing that back to the brokers, and to our clients, so that we can just be one step ahead and understanding not only what we're working on, on a granular level, pricing, capacity, the trends, tracking trends. Data is really king right now, and that's enabled us to, with Helen's help, create these new products and programs for us to be, more flexible and creative and provide solutions in the marketplace. But on top of that, we are, you never stop. You never quit of investing in your data.
Yeah, another thing that a very common request we get these days, generally we're looking 6 to 9 months out on project deals where people are asking for spec pricing, and they also started asking a year or two ago for limits benchmarking. So how much limit should I buy, right? Historically, we just kind of said, if I had a crystal ball, I wouldn't be selling you a wrap-up. I'd be retired. But today, we actually have that data. We can say to people with some certainty, hey, here is the portfolio of projects we've written here for the last couple of years. With this type of project in this area, the average buyer purchases X. Now, that doesn't mean anything. That's just, people looking at their peers for guidance, but we have those tools and we have that data. So a few years ago, we looked at this and said, data is the future of this business. It's going to help us transact tremendously. I mean, even in an individual deal, the more data you have, the better, right? More years of loss runs, the more years of exposure history, auto vehicle count history, the better that underwriter can get a picture of what they're doing. And on the macro scale, the more data that we have, it can help guide us in these different areas, especially within our specialty practice groups.
And the data that our brokerage friends are providing is invaluable when it comes to our underwriting operation as well. As Nick alluded to, it enables us to find where there's gaps in the market and where we can plug those gaps. It gives us really good information to take to the folks that back us up on that capacity when we do develop programs. And it also helps us from an individual underwriting standpoint. So I think our focus on data has really come a long way and will continue to be a focus for Amwins.
course, we shouldn't overlook as well, Helen, those relationships with carriers. They have a vital role to play.
Absolutely. Without carrier relationships, it's really difficult for us to place business in the market. One of the things that I really like keeping in touch with carrier partners. Now, from an underwriting standpoint, I look at it differently than our brokers do. I'm sure Jet and Nick will be able to jump in with their own thoughts. But being able to partner with them, find out what their appetite is, where they're struggling, what their future capacity constraints are going to be is super important. And being able to show them the depth of experience at Amwins and how focused we are on doing things right enables them to trust us and provide solutions a lot more easily than a firm they may not have as much trust with. One of the things I really like to do is if I can't help a broker on a solution, I like to be able to refer them to a carrier that I know may be looking at that slice of business. So I think it's important to stay super well connected with all our carriers, not just to place business, but to also help each other out to fill out capacity where needed.
To jump in, I have said this many times across my career. The worst deal you can buy is when you go to a bad broker and they don't market your account and they just get you a quote. You can get a better quote by going to multiple brokers who go to multiple wholesalers and carriers, and everyone's competing and killing each other. You can get a better deal that way. But the best deal that you can get in the market is working with a really strong broker who is an expert in the space, who has carrier relationships. They can negotiate the best possible deal for you better than you can get shopping. And I have seen this time and time again. When you have that working relationship with your underwriter and it's been going on for 20 years, let's say, or more, they trust you, you trust them. They will pick up the phone when you call. They will engage with you and listen to your story. They will approach the placement with an open mind, and they like you and they're trying to help you. Obviously, their number one job is to return a profit for their carrier. But if they feel like they can do that, they will go out of their way to try to make something work for us.
There you go. A great example and a fantastic way to wrap things up. Excellent guidance from you all, and no doubt our broker audience will have benefited greatly. So huge thanks to Jet, to Nick, and to Helen for their time today, and indeed to Amwins for putting together this expert panel. Remember, we will see you next time right here on Insurance Business TV.